Hey everyone, we got news that Walmart decided to sell the rest of its stake in Chinese e-commerce company JD.com, and that's raising questions from investors asking if they should sell their JD.com shares as well. So I'll answer that question in this video, and I'll review the news from Walmart on why it sold JD.com stock, whether or not they're going to continue their relationship together, and what it could mean for JD.com stock investors and Walmart investors as well. So let's take a look.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Walmart's saying that the decision allows us to focus on our strong China operations for Walmart China and Sam's Club and deploy capital towards other priorities. Adding it was committed to a continued commercial relationship with the Chinese company which carries Walmart goods on its website. Okay, so that's a bit of good news for JD.com in that they're committed to the relationship. So strategically speaking, that's not going to be a split. So they're not ending their strategic relationship. But what Walmart is doing is saying to itself, well, we have this several billion-dollar investment in JD.com. Would that capital be better served by deploying it in our own operations in China? So investing in Walmart China and Sam's Club China, would that be a better use of our capital? And for Walmart, the answer was yes. And so they decided to sell their stake in JD.com. So the sale, according to Reuters on Wednesday, said that it would be worth $3.74 billion at the top end of the offered range. So this will raise a substantial amount of capital for Walmart, which it can then deploy in its Walmart China or Sam's Club China, where it feels it will get a better return on investment. Now that remains to be seen, but given the struggles of JD.com in terms of top-line revenue growth and the competition with other online retailers with rising price competition, it could be an interesting decision for Walmart. Now, Sam's Club and Costco have done well in China, and so I'm not surprised that Walmart is, extending that investment in those companies, expanding that deal, expanding that relationship. So as I highlighted, sales growth at JD.com has struggled, and you can see that massive deceleration in revenue growth over the last decade. 10 years ago, JD.com was growing revenue over 50% quarterly year-over-year growth, and that's continuously decelerated all the way down until negative 1.39% in its latest quarter. And JD.com has several quarters in the last 6 quarters that have been negative year over year. Now the trend is improving slightly, as you can see, bottoming out here and then slightly improving on the trend line. Still, top line growth will be difficult to come by for JD.com given the rising competition and given the weaker macroeconomic outlook in China. The good news has been profit margins. So JD.com over the last decade has improved its operating profit margin from negative 5% in 2015 all the way up to 3.3% in the most recent trailing 12-month period. And that's been a consistently upward trend line here, as you can see over the last decade. Similarly, with its cash flow from operations, you can see a consistent trend line upwards, 6.73% in the most recent trailing 12-month period. If you look at its return on invested capital, again, a similar trend line going upward, return on invested capital of 9.11%. Now, all of these numbers, both in terms of cash flow from operations to sales, operating profit margin, and return on invested capital, although they're moving upwards, the numbers themselves are relatively low. So they need to move higher for several more years to get JD.com to an attractive investor viewpoint in terms of these margins. Looking ahead, the analysts on Wall Street expect JD.com's earnings per share to grow at just 3.3% over the next 5 years. And that will be a stark contrast to the previous 5 years, where its earnings per share grew by 32.6% in that time period. So growth both on the top and bottom line expected to slow down considerably for JD.com. The good news is that the shares are incredibly cheap. JD.com stock is trading at a forward price to earnings of just 6.5. Just 6.5. So this story of zero growth or very slow growth for JD.com is already priced into the valuation. It's already trading like a company that is not expecting to grow likely ever again. And so you're already getting that in the valuation. This is the valuation of a company that's not growing. So if there is growth for JD.com, if the company is able to reaccelerate top line growth, then that's the upside potential for JD.com stock investors. Now, that upside potential is partly why I've had JD.com stock rated as a buy, and I last updated that recommendation on June 7th. So following this announcement with the Walmart selling its stake in JD.com and resuming the partnership and the stock price falling as a result of this sale, I don't think investors should be selling. I'm not rating the stock as a sell. I'm not downgrading the rating of JD.com. I still think the stock is a buy after this announcement. In fact, after this announcement, it makes the stock more attractive because the price is decreasing, but the fundamental performance of the business should remain the same because Walmart's resuming the partnership with them. So the performance of the business, the underlying fundamentals aren't changing. You're just now getting a stock at a lower price because Walmart found another opportunity to deploy that capital and wants to sell those shares so that it can raise those billions of dollars and use it for something else. Use it for something it feels like is more attractive for them, which is investing in their own Walmart China business. It is an indicator that JD.com's growth is still struggling because if it was doing well and Walmart expected it to do better, then Walmart would have been more interested in retaining those shares because it would have felt they're going to perform well. But because Walmart felt that it wasn't going to perform well, then the comparison between keeping its stake in JD.com and using the capital to invest in its own China operations became more attractive in favor of Walmart investing in its own operations in China. So all in all, you're getting JD.com now at an even lower price, but with further indication that revenue growth reacceleration is still a long ways away. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.